So what I'm going to do here is just walk you through how I trade VIX. I don't trade the VIX futures. I trade the options. And again, like Lex said, I was a market maker on the CBOE and P Coast. I didn't learn anything about VIX until after I was a floor trader. So I was a floor trader for 15 years, moved to Maine like almost 20 years ago. And I kind of been on this rock teaching retail traders how to trade options now with Mark for about 11 or 12 years. So let's get into it. So I'm going to talk about VIX futures here. This is going to be kind of an educational thing. This is like basic understanding on how to trade or how the VIX futures work, and then how I use them. And at the end, I'm going to talk a little bit about, I think the VIX curve is probably the best information, best market information. And then I'm like, if I have like 5 minutes toward the end here, because I went on 11:20, now I'm looking at the time. I'll try to do a little freewheel on when I look at the vol curve, what I get from it. So one thing I think I try to teach my students at Option Pit is you take all the market information that you can, that is available to you. So the VIX futures curve gives a lot of information. I'm going to talk about contango and backwardation, those goofy terms, concept at Option Pit. And I think it's used around other like vol gravity, how the futures work, what you expect on how they trade. And what I call the easy direction, where I think you can have an opinion, but VIX wants to move. The VIX futures want to move the way they're going to move. So you got to understand how that is. And also degrees of backwardation. So basically how unhinged the market gets, you get a signal from the VIX futures. And if you understand how the market's going to trade, then in my mind, it changes the way you put positions on, right? You basically don't want to walk into a buzzsaw. So the first thing is this is not a complete list, but this is a list of products that I use that trade from the VIX futures. So the first thing is, what ETFs use the VIX futures as an underlying. So one of the misconceptions I think people get is, they call it the fear gauge and all this other kind of stuff. Really, all the volatility products trade off of the futures because the futures in the makeup of the product. So VXX, UVXY, those are two long vol products. SVXY is a short vol product. And then the options that trade off those. The VIX future is the thing that moves those contracts. Now, VIX does move, and it does move the futures for sure. But in order to see how those contracts are going to move, you have to see what the VIX futures are doing. So understanding how to trade VIX options, you have to get a sense of how the futures are going to move. So that's kind of what we're going to discuss here. Now, the product that uses VIX cash as an underlying 1 day per week. So the VIX cash only really becomes the underlying on settlement. It is an indicator of where the futures are going, right? Futures moving toward the cash VIX. But all of the options are going to trade off of the future, not the cash. They're only going to trade off the cash 1 day a week. So when you're looking at how these things are trading, you have to keep that in mind. Like where you think VIX could go is one thing. It's actually how the futures are going to move during that time that matter, not necessarily just what you think VIX is going to do. So what I do is the first thing you have to do is like read a vol chart. Now, this is a very old one. So in order to make trading VIX easy, right, which I don't know if it's easy, but to make it easy, you have to understand first what the futures are and then what the VIX cash is. So this is VIXCentral.com. Anybody can go to this website. It has delayed data from the SIBO. It works perfectly fine if you just want to get, especially for this kind of analysis. So the key thing is the green line is VIX 978. So for all of you right now that have lived through higher vol, VIX has been much lower than this over the last 10 years. Like in 2017, we spent so much time in the 12 handle and below, it was crazy. So, but right now, what you can see is the VIX futures are stacked on top, right? In this period of time, all these VIX futures are higher. And what we call VIX future premium is the distance between whatever the VIX futures are and whatever the cash is. This whole curve here, these are all settlement dates for VIX futures. In this case, what I would say is they're sloping upward from left to right. Right? So the back month is higher than the front month. So what happens is over time, there's a gravitational pull for the VIX futures to go to cash. So when again, like a sample thing, when I was a floor trader, and maybe Lex remembers this, but you trade and you go home and the vols that you put in to the machines, like to our quotrons and stuff. Boy, I'm dating myself. But anyway, you adjusted vols during the day. And then the next day, the vols were the same unless we changed them. So my general approach to trading VIX is it's going to stay where it is until there's a reason for it to move. So when I'm looking at putting on a position, can my position make money if VIX stays where it is? So again, that sounds like that's a topic maybe for discussion, but that's how I start a lot or most of my vol trades. Now, so again, the secret of trading VIX is making money from the cash to the future, or the future to the cash. So anything you do in VIX ultimately is going to be a function of how the futures are moving around. And they're going to move around a certain amount. So those futures are going to drift down to the cash number. Now, VIX can move up. They can move up into the, can move up into the futures, up and over the futures. But during the normal course of the day, VIX grinding down to the cash price is pretty normal. Like it's going to decay just like an option is going to decay. Now, when volatility goes up, options stop decaying, right? It's the same thing with VIX. The futures stop going down, stop decaying down as soon as VIX cash starts going up. So understanding that basic dynamic is going to help you trade VIX. Because if you're focused just on what the cash is doing, you're going to miss out on all of the products and all of the options and everything else that are connected to the future. So you have to start to understand the dynamic between the futures and the cash, and that's what we're going to do. We're gonna start to make sense of it, right? So, right, it's kind of like making sense of how the VIX cash is, right? You think about it like SPX is a cash trade. So again, VIX is a cash index and SPX is a cash index. Now, the problem is if you want to trade, like if you want to sell options in SPX, right, to sell volatility, right, the credit spreads and iron condors and all that and butterflies and stuff like that. The problem is path dependency. And path dependency is just like, okay, the market moves too much. So it's not that your iron condor, let's say, wasn't priced right. It's just SPX decided to go straight up for 2 weeks and blew through the top of your iron condor. You were right on the volatility going down, but your trade lost money because SPX moved basically out of your risk tent. So if you want to trade VIX or volatility as a direction, that's why people like VIX. So you can say, I think SPX volatility is too high. In the old days, right, when I was a trader, we would sell all the options around VIX, all the out-of-money calls, puts, whatever, wait for the vol to collapse. Now you can just buy a put, let's say in VIX, and ride the volatility down and not be so stuck with the path dependency in SPX. That's another reason why I like trading the product. Because you don't have as much management to do. It's not easy, right, to trade VIX, I should say, even though this is really an easy VIX presentation. But you don't have sort of the same path dependency issues that you do with SPX if you want to sell vol, right? You could just buy puts in VIX and, right, watch the futures drop and make your money on the puts. Again, if you want to learn more about trading iron condors and flies and all that advanced stuff, you can go to Option Pit. We teach our students how to do that all the time. So your VIX trade is a direction in volatility futures. All right. Now, the idea here is SPX is going to do what it's going to do, but the volatility in the SPX is mostly going to be anti-correlated. So SPX goes up and volatility VIX should go down most of the time. So, or if SPX goes down, VIX should be going up most of the time. So you have generally, right, you could call it like a non-correlated asset, right? Meaning SPX is going to go up or down and the VIX, right, should move a little differently, right? And move generally the opposite. So sometimes, right, when the market is doing all kinds of crazy stuff, like the fact that VIX is going up and rising in value is one of the few assets, like gold isn't, bonds aren't, whatever, but VIX actually, you get some performance out of it. And then, and you can recall like in 2020, when VIX went to 100 because of COVID, like the vol products, like a UVXY, all those products, had their moment in the sun, right, where they went flying higher. So trading it is learning how to trade sort of a non-correlated thing, non-correlated asset. So what is normal? So normal is a contango curve. Now, this funky looking equation, right, is the forward volatility equation. And all this equation means is when implied vol is lower in the front in a slow market and higher in the back, it's going to produce higher forward volatilities. And if you have higher forward volatilities, the VIX futures curve is just a forward volatility curve. So all those futures are going to be higher in the future, the lower volatility is in the short term. So when the market's not moving very much and implied volatilities like they're doing actually currently into this NVIDIA earnings, right? So the market's not moving much, realized vol is pretty low, implied vols are super low in the front. Those are going to produce higher forward vols, and the futures are going to price higher according to this equation, right? So T1 is just a short-term vol, T2 is the back-term vol. So you can see in the equation, the lower T1 goes, the higher the forward vol is going to end up going for the equation. So anyway, so VIX, right? So future prices should be higher under normal circumstances, meaning VIX futures in the future are going to be higher under normal circumstances. This is another reason traders like selling volatility. And the idea is how selling volatility with VIX options, you could either sell the calls, right? Because there's call skew, they're generally expensive, or you can do a lower risk put purchase, either one. But you always, for the most part, when volatility is low in the front, you are getting, right? You are getting higher future prices that you can sell. I don't know if I would call it like the vol risk premium that everybody talks about. I guess you could loosely. But in general, insurance is priced more expensively in the future, right? Not less. So what that gives you is, right, that gives you some opportunities. Now, also VIX moves a certain way. VIX cash moves like few products do. I think, to be honest, it's unique. It's a volatility product. It is not something that Black-Scholes assumed that had a normal log normal distribution as far as, kind of paying a dividend and going up every year. VIX moves like volatility, what they call reverting, kind of up and down. So it moves differently. It goes up for a while, right? Tends to crash up, and then it melts down, not quite as fast as it goes up. Usually just think of it this way. It's like, it's basically like a match, on gasoline, and then it takes a little while to put out the fire. So VIX tends to go up quicker. Now, VIX futures tend to move on a delta to the cash. So a general rule of thumb is the 30-day future will move around 50% of the cash price when we're in contango. And remember, because those futures are already priced higher, VIX can have a little move, and you won't get as much of a move in general out of the future. So when you see people saying, oh, VIX has moved a ton, VIX has moved a ton, but you're not getting huge immediate performance out of your trade. Let's say you bought some calls. It's because there is a delta to that future, a 30-day future. Now, these are general notes. Again, we teach this in some of our courses at Option Pit, probably now in Trading Desk and Weekly Profit Cycles and in Pro, stuff like that. But what I want you to notice here on this screen is that VIX cash is moving, right, up, but all of the futures that I have circled there are moving at different speeds, basically. So what you can see here is you have a move in VIX cash. The 29-day future covers about 50% of the move, right? The one-day future is covering around 90% of the cash move. And then again, the difference between the 1 day and the 30-day is about 10% per week. So basically, if a 1-day future is moving around 90%, an 8-day future around 80, then 70, then 60, then 50. So you think of it basically, 30 days out, you have a 50% move, 3 weeks in around 60. So what it does is the futures move kind of, this is roughly, not exactly, but roughly on that ratio. When you have a couple of days to go, the future is, like I said, will move around 90%. With 30 days to go, the future is only going to move around 50%. So if you're trading it, you have to have an idea of how much your underlying is going to move if VIX moves. Again, these are approximate, okay? They're rarely exactly this, but in contango, right, generally like this. And remember, contango is just that upward sloping curve from left to right. So how I trade or create VIX trades is I think of it two ways. You have a shock trade or an erosion trade. A shock trade is basically when I think VIX is going to fly. Okay, so I think the cash is going to jump higher, or I think the cash is going to ride lower, sharply. And I'm going to pick a different strategy than if I just think that the future is going to erode down to the cash over time, or the future erodes up to the cash over time. So you have kind of two speeds. So VIX itself as an underlying cruises at two different speeds. So the futures will erode every day, right? But they also can move in a shock when VIX moves hard. So the first thing in my head is I have to decide what kind of move I'm going to get out of VIX. What is vol going to do? Again, spending my whole life as a floor trader, basically, or my pre-option pit life as a floor trader, all we did was trade volatility anyway. So it's not too big of a stretch for me to trade it now. So this sets up, again, basic strategy, shock or erosion. So when do I want to trade for shock? When do I want to trade for erosion? So you got two speeds, right? Shock speed, erosion speed. So a shock is when the VIX cash moves so fast that it'll actually pull the futures out of their current shape. That's when you can make money, let's say buying calls in VIX. When VIX spikes, it rips the futures higher, and they're moving enough for you to make real money. 2020 is a great example of, VIX continually going up and up and up and shocking up. then it spent the next 4 or 5 months sort of coming back to earth, slowly but surely, down to the 50s, then the 40s, then the 30s, then the 20s, and, slowly but surely. Okay. Erosion tends to take some time to happen. Basically, if VIX doesn't do anything, what are the futures going to? The futures will gravitate toward that cash number. So I always think of this as the futures always move to the cash. Now here, again, we're focusing on which way things are going. So now when we look at a contango curve again and what vol gravity is, and then my students always ask me, what's moving, like the VIX or the futures? Well, the futures are always moving to the cash. Okay, always moving to the cash. So the easy direction in this case is down. So again, you're looking at the cash here is 1190. All these futures are in, 14, 13, whatever, all the way up. The easy direction will always be down. Right. So there's a lot of folks that, buy puts in the vol products like UVXY and stuff like that, or buy calls in SVXY. It's because that decay, that gravitational pull, right, is changing the value of all those contracts, right? Because they all own VIX. VIX slides, UVXY goes down, SVXY goes up. So again, the vol gravity tells you where the futures are going to go till expiration. So unless something in the market changes, the futures go to the cash. Like literally, if I go 30 days from now and VIX is 1190, that near-term future will be 1190. Okay. Now, something different. Okay. VIX in backwardation. This is a totally different curve. So you have VIX trading 23, almost 24. And here the futures are all underneath the curve. Again, via the forward vol calculation that I gave you earlier. Again, don't have the whole, we only have 40 minutes here, so I can't work through all the numbers and everything, but just trust me, that's kind of how it works. So what's going on is every day that goes by, as long as VIX stays at a 23.57, all of these futures are now going to rise up to the cash. So again, changes how I strategize, right? What is the way, right? What is the way volatility is going to go, right? The futures are going to keep moving up to the cash. Now you're saying, Andrew, what if VIX doesn't stay at 23.57? Well, it can't. So, but I changed the structure of my trade slightly because I know day after day, as long as the conditions are the same, whatever made VIX go up there, until that changes, right? Until that thing changes, VIX will not come back down again. Now, it might change tomorrow, but in the short term, the gravitational pull is upward. So, call spreads, call butterflies, stuff like that, right? Remember, the underlying price is very low relative to where the cash is. So instead of me paying $24 for an underlying, if I'm buying calls, I'm only paying $21.87 if I'm trading an option with 60 days to expiration. I'm only paying $22.27, or like almost $2 below cash. So calls trade low. So if you stay in any kind of a vol event, right, the futures start moving up toward the cash, it makes calls relatively inexpensive. So this is kind of one of the odd things about VIX. When you're in backwardation, calls and call spreads, call butterflies, things like that trade cheaper because the underlying is so low. When you're in contango, it's the opposite. Your underlying price is relatively high because the VIX future is so far above the cash. And then all the puts tend to trade inexpensively. So you work your trade, right, depending on sort of where the easy direction is going. At least that's what I teach my students. It tends to work pretty well. So most successful, again, my opinion, successful VIX trading is based on vol gravity. So you can be one of those traders that says, okay, VIX is 12. It ain't going to stay here, and I'm going to buy calls and sell puts. I'll do a risk reversal, until vol goes up again. And that could work. Okay. That could totally work. The problem is, we could stay at a 12 for a while. We might, right? Vol might not get off the mat, and then your risk reversals basically gets smoked. You don't make any money on them. It doesn't, right? So you could trade VIX cash like that for sure, and you're trading the futures, but the gravity part is not going to go away. So when you're in contango, remember, if you're buying calls, you're always spending more money on those calls. Right? Doesn't mean they can't make money, but you are starting paying more money from the get-go. All right, I only got a couple more minutes left, I think, according to my calculations. So, so remember, your futures are the underlying for the options, and you have to figure out the easy direction, the gravitational pull first to start your position. So when you walk into backwardation, okay, you know that things should be lifting up unless VIX does something drastically different. Same with contango. So, right? So the degrees, the next part is your degrees of contango or backwardation will show market sentiment. So I got like 3 minutes left, I think, till Lex pops in. Again, my rule is this: IV stays the same until it has a reason to change. Now, people can disagree with me all you want, but that is my assumption when I trade vol. I just have to make sure that my position makes money if implied vol stays the same. Will I make money, right? If the realized vol stays the same, will I make money? Again, if all these concepts are foreign to you, stop by Option Pit. Again, this is what 15 years of market making taught me, right? That's what it is. So it's the tendency of implied volatility to move to the realized vol. Okay, that is a long-term tendency. Realized vol is just how the underlying market is moving. It doesn't always do it instantly, but it's a strong gravitational pull. So VIX futures generally go to the cash. Okay, because remember, they're going to expire into cash. So this gives you like a little flavor, right? So when the VIX cash is the black line, our green line, what I call slight backwardation. Slight backwardation. Meaning the market is getting a little bit jiggy. Okay. The second, right, let's say second term you see here is now your tip is pointing up, but more of the back term is relatively low. The green curve is still almost, you could say it's a contango looking curve, but VIX cash is relatively high. So the market is starting to pick up momentum. As soon as the front of the curve gets higher than the rest of the options, then again, I would call medium backwardation. And everything is, the market is definitely starting to freak out. The last one here is when we're in what I would call total backwardation. Total backwardation, meaning VIX cash and every term behind it, VIX cash is the highest, and then every short-term future is above every long-term future. That's when the market is totally unhinged, and you expect, SPX to basically do anything. You can move 1.5% to 2% per day in the underlying. So the shape of the curve, again, we go more into this in detail on Option Pit. This is a very short presentation. What I'm showing you is the fact that you have those VIX curves changes shape. The market is telling you expect a certain speed out of SPX. And once you learn how to do that and do it relatively well, it helps you position if you want to trade SPX, you want to trade equities. And it makes life a lot easier, at least in my view. Okay. Now, a couple of things. Zone one, and this is sort of a Option Pit thing, but whatever, we break VIX down into quartiles. Zone 1 is 9 to 13. Zone 2 is 1301 to 1799. VIX spends 50% of its time below 18 and 50% of its time above 18, right? Actually, so this is data that I looked at years ago. It's roughly still about the same, even though we've had higher vol recently. Zone 3 is 1801 or 18 to about 2399. And zone 4, the last quartile, is 24 and above for VIX. So when you go back to this curve, right, these numbers here roughly, right, roughly coincide with where VIX cash is. So the green curve, orange curve, and red curve, right? When you're in zone 4, that's super high vol, danger zone. Zone 3, you have like mid volatility. The market is just kind of getting moving. Zone 2, that green curve, is when all of a sudden VIX just pops because the market does something, but we don't get out of, the shape of the curve doesn't change very much. What you're getting is just all of a sudden vols in the short-term pop in SPX. Zone 1, where we spend most of our time, right, 9 to 13, is that contango curve where you have volatility very low in the front and volatility's higher in the back, produces that contango curve. So what I'm saying is, like, the nature of the backwardation you see when I set up vol trades, let's say in trading desk, is it's very curve based, meaning we're in zone 1, 75% of VIX is higher. All right. When you're in zone 4, 75% of VIX is lower. So when you're trying to set up trades like that, you're sort of leaning in a certain way based on where you are in the zone. So you have a couple of things when you think about setting a trade up, right? What the curve shape is, what zone we're in, right? And what direction vol has just gone. Now, so what I do is, like, if you want to trade VIX options, again, this is how I trade them. You can trade them any way you want. But what I do is, you want to start, right, with the degree of contango or backwardation that you see. Like, how steeply pointing down are we? How steeply pointing up are we for backwardation? That does is that gives you like a kind of an idea of velocity of the market. Again, if these terms are foreign to you, sorry, but I'm trying to, use terms that people can understand, especially if you're new to VIX or volatility. Again, setting up the direction, right? The next thing is pricing the easy direction. Is where is the future moving to? And then the next thing is I pick duration, again, based on where we are, creating the right position for the term, and then estimating the risk and payout of whatever trade that we see. Like, does it look like a good enough trade? And ultimately, when you go through, right, your process, right, this is my process for trading VIX. What that does is it helps me put on a particular type of trade. And I think, yep. And then we're at the end, right? So I guess Lex will be coming in here in a minute or two. So what I want to just point out is just, okay, if you have a live curve today, what are you doing with the live curve today? Let's see. So VIX futures term. So when I look at this curve, so you're like, you see this funky kink here, first off, right? That is just the election. The market is pricing election madness, and it's not going away for right now. So I look at that as kind of an outlier. Another thing too is I don't like trading a lot of VIX over 60 days. The reason why is the future's at such a high premium to the cash. When you're going farther out, they don't move very much. So one thing you'll notice is all the volatilities of VIX options, the farther you go out in time, is actually less. It actually works opposite than regular equities and index options do, because the future premium is so high, like they don't move basically. So if you want action in VIX, all the action is basically 30 days and some 60 day. I don't see a ton of action past that. Doesn't mean you can't put on like a vol, like a Vegas centric trade or something, but I don't trade it because it doesn't move enough for me to care. So right now you have VIX is trading 1356, the June contract, and the July contract is 1443, trading well above where the cash is. So that means VIX puts are relatively inexpensive. Like right now, so personally, right, I'm buying 14 puts and I'm spending just like tiny amounts of money to hedge that position because I'm basically waiting for the puts to pay me pretty decent money, should pay for whatever the hedge is. And then, but basically, the easy direction for me is down. As low as VIX is, I plan for the vol futures to keep going down. And then I hedge for what I don't expect to happen. Meaning that we have some event, like maybe the NVIDIA earnings are terrible. Who knows? And we drop to 5,000. I don't know. It could happen. Right. But I generally hedge for what I don't, what I don't expect, but I'm going to trade for what I do expect and what I see in front of me. So when I'm looking at vol futures where they're currently priced, I see them slowly moving down to the cash. So I'm going to set all my positions up, or most of them anyway, right? Short vol by buying puts. And then I see what happens. I basically turn it on and let the music play.